Alright, so what I'll be doing is I'll be going over the SPY charts that you see and reviewing them. This is part of the trend review routine. It's a pretty helpful routine. So at the top you have a 10,000 tick and the bottom you have a 1,000 tick. Why tick charts are much better than time-based charts in my opinion? Well, you have pros and cons of both charts. Tick charts, they show trend much cleaner, and I think you can see accumulation and distribution also far easier on tick charts, whereas on time-based charts, what the real benefit of them in my opinion is you can see price volume thrusts. So big bars with big range with big volume. That price volume thrust is in my opinion is really valuable, but I like tick. Alright, so we're going to go over these charts, and I'm going to combine the higher time frame, which is a 10,000 tick, with the lower time frame, which is a 1,000 tick. So we'll start off at this point on the higher time frame first, and you'll see why in a second. So the market is going up, as you can clearly see, and why I'm selecting this point is because of this. See that? That right there is distribution. Someone, this game really comes down to buying low and selling high. Alright, and obviously low and high are relative, but as you can see, as price is going up, someone is selling high. Alright, as price was going down, what was this? Someone came in and bought the low. So price is going down relative to the time frame, relative to all that. Price is going down, and what did someone do? They bought the low. Then they take price up until you have big red, which is just selling or distribution. So someone's selling high. Really, this is no different than any other business. Smart money buys low and sells high relative to the time frame that they operate on. So someone came in and 250, I think this is in 10,000s or 100,000s volume, whatever it is, who cares. Over here what you see is you have 250, and I know that's a lot of volume. That's what's important. Okay, what other pieces of information do I have? I have that before this sign of weakness, as is called in Wyckoff, or distribution, or change of behavior, whatever the word is. What do we see before this? We see 163 up, which is the highest wave up in the trend since the inception of this trend. Over here at 176. This means that when you have that kind of volume coming off, at what seems at the time higher than the low, relatively speaking, it means that it's climactic. Climax, or what is known as a buying climax. Okay, now do I know at the time this is a buying climax? Actually I do, because it's I'll take that back. Maybe I don't, maybe I do, but I know relatively speaking it's higher than this wave, and it's comparable volume. At this point here, 250 is bigger than 163. And immediately I know that's a change of behavior. I know that's a change of behavior for many reasons. Not only is it higher than the biggest wave within the prior trend, but it's higher than this, than the initial sign of strength. Whoever bought got out. Remember, buy low, sell high. Buy low, sell high. What is this telling me? Whoever bought the 176 is out here. Why? 250 is greater than 176. Even if it was comparable, it would give me evidence that these buyers are out. Okay? So these are the guys. They came in, they pushed it up a little, and who knows what they did here? Probably sold, and this is the evidence of their selling. Buy low, sell high. Okay, so we're at this point, which means that this must be the climax, and even if you don't think this is a change of behavior, you must accept that this is high volume relative to the trend. I mean, it's obvious change of behavior, but many times you see you want more confirmation no matter what. So up here, what we have is at least high volume, but in my book it's definitely a change of behavior because I know these guys got out. Alright, so now that they're out here, I want to see a lack of demand. I want to see that demand is weak, and I want to see follow through selling. What happens is, you have this up wave of 176. Now, when you have 250 down and 176, it seems a bit confusing because you think that possible reaccumulation has occurred. So what's really going on? Is it reaccumulation, or are the sellers in control with 250? I know that this volume is greater than this volume, so that's one hint to believe that the sellers are still in control. The second thing you want to note is that this high hasn't been taken out. The point of initial selling has not been taken out. So until it's taken out, you can't say that the buyers are in control. Sellers are still in control. Then eventually, this 23 here, and pardon the marking over here, just doing some indicator stuff. This 23 here is really, really, really important. It is important because it is the LPSY, last point of supply. The 23, is this a big number or a small number? It's a small number, and it's a small number followed by a thrust. So you got heavy volume, and in the middle you really cannot tell. In my opinion, what you should do is not pay attention after that heavy volume and look for low volume, meaning you're looking for the 23 so the middle doesn't confuse you. A lot of times this is what happens after heavy selling or heavy buying. The market starts acting randomly, and what you need to do is know what you're looking for. Only look for that low volume and ignore everything else in the middle, and you finally get that low volume and you finally get that thrust. So you have that heavy selling, then you eventually get the low volume and you get the thrust, which means what? You got supply, you have a lack of demand. Okay, so heavy supply and a lack of demand together, heavy supply plus a lack of demand together, followed by a thrust that breaks the low of the supply area, is confirmation that the market has now shifted to a state of markdown. You have left the distribution phase in which there is a sign of weakness, which is just heavy selling. It's just heavy selling. Let's make it really simple. You got selling and no more buying. What do you think is going to happen to price if you have selling and no buyers? Will it go up or will it go down? You got sellers and no buyers. And then came the thrust with follow through. That right there broke the back of this uptrend. The back of this uptrend, is broken. This uptrend is officially broken on this thrust with this sequence of heavy selling, lack of buying, and a thrust, especially with follow through. So again, this is a SPY. It's not the easiest market in the world to read, but these principles are really timeless. Anyway, so after that happens, you sell the retest. Alright, that's it. Sell the retest. The range is broken, the breaking of the ice. Even if when the ice breaks, understand how it breaks, why it breaks. This, what I'm explaining to you, is a manifestation of the first Wyckoff law, which is the law of supply and demand. Increase in supply, lack of demand will force price lower. That's what's going on. After it breaks, it retests, you sell. They do an up thrust of this area because they're smart, and then they take it down. Now, very rarely do you have such little movement down. Very, very rarely. I'll be expecting far more movement down. Okay, this is one of the issues, is that with a lot of Wyckoff traders, is that we need to use point and figure to project the target. And the problem is, in my book, point and figure does not work intraday. So what do you use intraday to help you project the target? That's one of the things Wyckoff traders have a real issue with. Some people say point figure works intraday. I don't think it does. I know it does. It does work on longer time frames with big bases. It works really well, but in small time frames, it's too much randomness, and you really can't project. I tried it already. So anyway, this right here, 180 up. Again, you get a little confused, right? What is this? But it's an up thrust of the area to run the stops, and then the market goes down. Typically, it should have gone down much more, and and a downtrend should have been initiated, and that's what's going to happen most of the time. So, how do you know you're in trouble? How do you know that the market's about to reverse back up? When the market breaks and continues lower after this heavy effort, what happens is it hits 173 and then it attempts to go lower and really break at this point. But does it break? It doesn't break. Instead, it runs out of volume. So this right here, what is this? Some may say this is a secondary test or whatever, but this is the concept of shortening of the thrust. Shortening of the thrust, what you'll typically hear about it is, you have one wave and another wave, and the distance between those waves is small, and that's a shortening of the thrust. Or you have one bar and you have another bar, and the distance between the high to the next high is small. But that's really not it. That's just a measurement. Shortening of the thrust as a trigger is different. This right here is a shortening of the thrust. A tradable shortening of the thrust, where you have a climactic volume and then it all just disappears with very little progress. This down move is on 171 volume. Okay? Now it tries to continue to go down, but what happened? You go from 171 volume to 23 volume. What's that telling you? It's telling you I don't have no more sellers. I don't have no more sellers. There are no more sellers. Incidentally, when the market broke, it also broke when there was a lack of demand on what? On 23 volume. Now, when the reversal back up is occurring, it's also on 23 volume. 23 in this market is definitely, at least at this time, is definitely considered a lack of demand. And I bet if you look over here, what do you get? $23, $24. What happens? Goes up. Watch. What happened? How did this market break? In even a prior trend. This was the trend. That was the bottom of the trading range. Yeah? What happened? Lack of demand. After, before the break. What did it happen after the break? Ba-dow. It goes down. Hey, I could go on and on, but what you'll see is in most markets, LPSY can be quantified by a certain amount of volume. This is very specific to each, and this is what professionals know. Professionals who trade one particular market or two markets, they typically know the low volume number in that market. It's very important to know that low volume number, because when the market hits that number, you know that if it reverses back up, it has a potential for making a big move. Okay, in this case, that 23 right before the break represented the lack of demand. Alright, so where was I? So in this case, you have a shortening of the thrust on lack of volume. All this is telling you is I don't got no more to sellers. This is considered very low volume for this particular market on this particular time frame. Alright, most folks will just look at the stupid histogram and see, oh, this is low. But how do you know what low is? Is it because it looks like it's low? No, with the actual number is telling you a much detailed description of what low volume is, and this, you know, is low volume for this market on this time frame. After that shortening of the thrust, what's critical is an actual thrust. Okay, so what you notice is you're looking at this 23 and you think, maybe it'll go up and then come back down, because this is a, this is a bear trend, right? Bear is broken. But what you notice with the shortening of the thrust, what's really important is when they break this area, which is the pivot or even the low bar, it should be a thrust, and this is a thrust. Thrust you can measure by using average true range. Alright, it's a very simple technique for a thrust, and that bar is a thrust. Just like this bar was a thrust down, but it didn't find any volume. Just like this bar was a thrust down, but that caused the break. This bar is a thrust up, and that bar is telling you that this is a breakout, and you have potential to go higher. It's aggressive buying. So now what do you have? You have another change of behavior on 240 volume. Why does this matter? Look at how the market broke. When the market initially broke, it broke on 250 volume. So is it possible that these same players who sold are now covering the position into Friday? Whoever sold into Thursday, they don't want to hold over the weekend because shit happens. So now they're covering their position, saying, uh-oh, you know what? Too much political uncertainty. Let's buy it all back. So they sold, took the price a little lower, and they came right back in and bought it all right back. Again, the game is selling high, buying low, just like any other business. And these guys, they bought, pullback is on 23 or 24, and now it's going up. Now, will it continue up? I can't predict that. Nobody can, because just like this couldn't go down because of a shortening of the thrust, you could have the same thing happen here. So this is what's really going on, and that's it. This is This is a lesson for you and a reminder for me on how to use Wyckoff tape reading skills. We went over distribution, breaks, shortening of the thrust, LPSY, the importance of knowing the volume print, not just the histogram, because that's how rejections happen. The importance of low volume followed by a thrust. Low volume followed by a thrust that breaks a low or a high in this case, and a low in this case. And that's all. Peace.